Good morning and welcome to Weekly Profit Talk. As you might have gathered, we do this every single week. We do this every single week, 8:30 a.m. on Wednesday. That is the Mountain Standard Zone. We're on standard time now, have been for about a week and a half. So, good morning and welcome, everybody. Today's topic is 2 months to go, financial musts for private practices. Thought this is a very good and expeditious time to be doing this because believe it or not, and this is true, let me go ahead and I'll share the visual aid here. It's hard to believe, but there are only 50 days left in this year. That is absolutely the truth. It makes you wonder where it went, or maybe not so much. For some, it may feel like the year's been about 3 years long. So, but in any case, time is ticking away, and there are things you can most definitely do right now in the month of November and also in December to ensure that you are maximizing your financial situation to the best ability. One of the main things as a private physician entrepreneur that we always want to be conscious of is the money that you make results in some sort of taxes. And taxes are probably one of our biggest expenses in this country. Excuse me. So it pays to plan for it. This can save you hundreds or even thousands of dollars. And as I said here, there might be peers of yours out that are spending more time planning their holiday annual party and taking care of ephemera than uh, taking a look at this very important facet of their business, because you are in business and almost all the action that you can take has a deadline, and it is December 31st. And by the way, we're recording this on November 12th. So, like I say, 50 days to go, right? No time like the present. Your November action items. A couple of things to talk about here. One is capital purchases. You've been daydreaming about getting that imaging equipment in your office to keep from having to send your clients out, your patients. I'm sorry, I have clients, you have patients. Having to send them out for tests to someplace else when you can keep this business in house. Also, there are a couple ways to write off your capital purchases to the extent of the actual cost of the asset, depending, of course, on income limitations. I don't know those exact numbers, but as long as you're making, as a matter of fact, hang on a second, and I will take a look. And I appreciate your patience because they did increase this. Right. So the maximum Section 179 deduction, and this is basically writing one thing off. By the way, OB3, that's shorthand for one big, beautiful bill. I get tired of saying it, so we just shorten it to OB3. It's the One Big Beautiful Bill Act. It became law on July 4th, 2025. There are a lot of tax changes stemming from it. If you'd like to know more about that, we'll certainly be talking about it in the future. But also, we have past blogs on the website, owingsllc.com/blog, and go into the subject in some depth, starting from back in the summer. So there's more information for you there, and hopefully you'll find that helpful. So you can also go to the YouTube channel because we actually record what you're seeing right now and save it for posterity every single week. So if you're on YouTube, don't forget to subscribe. Thank you. So it looks like the maximum deduction for 2025 tax year is going to be $2.5 million with a spending cap or phase out threshold of $4 million. So it fully phases out when you reach 6.5 million. I would say for most people listening to this broadcast that is probably not going to be a problem. But bonus depreciation is back. That was decreasing since COVID by 20% per year, with a low of 40% last year. It's back at 100% and will remain there for the next 4 years. Now, that doesn't mean you want to take 100% of your depreciation with either of these methods, but it does mean that you have the flexibility to do so. When would you want to completely depreciate an item that costs over $100,000? Let's say you're having your best year ever and you're taking a look at your bottom line and you're going to be paying taxes on $250,000 and you have failed to make good estimated tax payments earlier in the year. Now's a good time to be listening to this kind of advice because lowering your net income, is going to lower your tax. One goes hand in hand with the other. Another November action item to take into consideration is tax deferred retirements. If you have the right kind of 401k, particularly if you are now, you may offer 401k to a staff, or you may basically be a sole proprietor and have a solo I-401k of your own. Either way, there are ways for you to contribute up to $70,000 a year. And to do this after tax and contribute this in Roth, it's one of my favorite things to think about doing. Now, there may be some that will argue with me, well, you contributed to traditional IRAs and you get to defer the tax, right? So in other words, you contribute the money and then you pay tax on the rest of what you earn and you get to skip the tax on that contribution. Well, the problem with that is when you take that money out many years later, either in required minimum distributions or whatever reason, you're going to pay tax on it then. Whereas Roth, it's the other way around. You make your contributions after tax, less paperwork at the front end. And at the back end, when you don't know what the tax bracket's going to be and how much we're going to be paying in taxes in 2050 or 2060, you're going to have tax-free income from your Roth retirement. So I love me some Roth, and you should too. You may want to think about doing traditional Roth conversions. Your existing balances may be subject to taxation. And what this means is if you already have investments in traditional IRAs or traditional 401ks, and you want to roll that over, that's basically going to be a sales event. And a sale is going to create either a gain or a loss depending on how much the stock was when you bought it. So you need to plan for that. It's not always in your best interest to convert your entire holdings if you're going to be paying $5,000 or $6,000 in tax on it. But you may want to spread that over some number of years, or you might get lucky and sell it in a dip where you're closer to your cost basis, which is what you paid for it when you got it. So there are things there that might require some expert guidance, and that's what we do here in case you ever want to ask for help. Contributions to IRAs and 401ks can, in most cases, be made all the way up until April 15th, if the calendar year is your tax year. So keep that in mind too. That's the one instance where you don't have a deadline of December 31st to act. But keep that in mind because this can, in fact, dramatically reduce your taxable income too. So let's talk about December, which is here. It's now or never. Once December rolls around, you're going to have 30 days left, not 50. So here's a couple of things that you want to think about. Expense acceleration. If you're reflecting a better year than the year before with your net income, then the time is ripe to take a good hard look at the kind of things that you can pay for that are ordinary and necessary to your business and get that under the wire before the year ends. Insurance premiums are a good example. Everybody's got malpractice insurance, for example, but you're going to have liability and other things. If you own the property you work in, of course, you're going to have commercial real estate insurance as well. So if you don't, office lease recognition, I find that this often happens that lease payments will go out somewhere near the end of the year, and sometimes they kind of end up hitting in the next month. You want to be careful as much as possible to make that last month's payment in enough time where your leaseholder's bank will clear it before the year ends, and you're able to recognize the expense in the year that you're making it. Expenses drive down your net income, driving down your net income drives down your tax. So income recognition. If you're having a good year, consider the payments that are coming in late in December. Um, you're going to be kind of dragging around a little bit after Christmas anyway, right? Maybe your staff is now. Certainly, I'm not saying that you're so unprofessional that you're not going to get your work done, but it's quite likely and totally understandable and completely legitimate if you just happen to deposit those checks after the January 1st holiday and the income is actually recognized in the following year, where you can take 11 and a half months tax plan for it then. Um, if things aren't so doing so well, then it's time to work your receivables and hit those phones. Call in your outstanding patient balances and let's get those paid. The end of the year approaches with 50 days left. We thought this would be a good topic for this week. Um, we are going to come to you with some sort of topic every single week on Wednesday, and hopefully you found this one helpful. Um, we're looking forward to sharing something new with you next week. That will be a Wednesday at 8:30 a.m. Mountain Time. That is 7:30 in LA, 10:30 in Florida and New York. So until next week, so long for now. Have an amazing rest of your day. And if you have a chance, do something randomly kind for a stranger today. So easy for me to say. With that, so long. Have an amazing rest of your day. And